Assalamualaikum. I'm Juwairi Abidin, a student of SAST CSC 21 session. I am here to present for ECO 105D assignment, and I am assigned to Chapter 7, Money and Banking. So, today we'll discuss what is money, its definition, and how it works. So, what is money? Money is a medium of exchange. Money is a medium of exchange widely accepted in transaction for goods and services. It has several key functions as a medium of exchange, unit of account, store of value, and standard of deferred payment. Okay, uh, so it has different characteristics. And what are the characteristics? Uh, you may also call it essential property of money. So those are fungibility, interchangeable units. Secondly, durability, which means resilient to multiple exchanges. Portability and divisibility, which means easy to transport and divide. Recognizability, which it meaning is authenticity, easily verifiable. Stability, constant supply to prevent fluctuations. So, how money is evolved? We see paper money these days and digital money these days, but how did it come from? How people got the concept of money in the first place? Okay, uh, for in earlier days, firstly there was barter system. So, what is barter system? And if one can get goods in exchange for commodities or other goods, it's called barter systems. It simply means goods for goods. For example, one needed 1 kg of rice. Huh. So how can she or he get 1 kg of rice from another person? He will exchange something else, something of same commodity with the other person, the buyer, the seller. So that's how it is to work. So what is the problem with it? So the problem was the accessibility. After barter system, there came commodity money. And what is commodity money? Physical goods such as grains, livestock, and metals were used as a medium of exchange. Today we don't see commodity money. Why did it change? Was because it has few problems like divisibility and liquidity. And there came metal money. What is metal money? Metal money refers to coins made from metals such as gold, silver, copper, or other alloy which are used as a medium of exchange. And its problem was purity, rarity, liquidity. Then there came paper money. And what is paper money? Banknotes made from paper. The paper money solved the problem liquidity, but still has few problems like fraud, carrying security. And there is plastic money or digital money. What is it? It's actually debit or credit cards, cryptocurrency. Those are called plastic money or digital money. What's the problem with it? Security, cost. It's really costly and not controlled. It's not controlled by any authorities. So this is the evaluation of money. Well, the next topic is functions of money. So what are the functions of money? They are unit of account, a common measure for pricing and services, enable standardization, interest. Then the next function is store of value. It allows individuals to preserve wealth for future use without significant deterioration in value. Thirdly, there come standard of deferred payment. And fourthly, medium of exchange. It enables a smooth trade for retaining value across various transactions, promoting savings and long distance trades. So the next topic is demand for money. Why money is needed? What are the demands? Why someone would have money? So there are several reasons for demand of money, such as transactions demand, precautionary demand, and speculative demands. The transaction demand is for daily transactions, precautionary demands for emergency causes, and speculative demand for business purposes. The precautionary demand, also called as rainy day money. Why is it rainy day money? Because, for example, you are on the road and suddenly rains. It rains, then you need rickshaw, and to ride a rickshaw, you need money. And that's why it's called rainy day money. The next topic is supply of money. How money is supplied, how it's controlled. These are really important questions. How money is created? So the supply of money's components are currency, deposit, large deposits. Currency can be two types: currency outside bank, cash in public demand. Deposits are same, checkable deposits, saving deposits. Large deposits are only one type. They are time deposits. Okay, so there are different kind of money, such as broad money, includes narrow money and time deposits. Narrow money is currency and deposits. Currency is cash in public demand. The money supply consists of currency, deposits, large deposits, like time deposits. Narrow money includes currency and deposits, while broad money includes narrow money plus time deposits. Central bank manage the money supply to influence economic activity and inflation. So basically, bank is the one who controls money. And how they control it? They control it by keeping reserves. The commercial banks needs to keep reserve in central bank for a certain portion of their time deposits. Okay, so the interest rate of reserve is the money multiplier or deposit multiplier. From the deposit multiplier, money is created. So here we have discussed the commercial bank assets, uh, liabilities. What are the liabilities? Central bank's assets, liabilities. So what are the purpose of money creation? They are needed for treasury, tax payments, banking system, the loan creation, deficit spending, and there are various purposes. So, uh, so money is created by a huge process. Let's see for example. Suppose someone has $100 gives to a man, and the man deposited in the bank. If the reserve ratio is 10%, then the bank has to give 10% of that deposit money to the central bank. That's how money is created. Here we have seen the deposit multiplier D is equal to 1 divided by R. And money multiplier is we are going to see money multiplier. The money multiplier effects demonstration demonstrates how an initial deposit can lead to a larger increase in the overall money supply as banks loan out a portion of their deposits, which are then deposited and reloaned. So the money multiplier quantify how much the money supply increases in response to an increase in the monetary base. High powered money is central bank's money, H is equal to C plus R. And formula is equal to MH, where M is the money multiplier. As we previously shown, if the reserve ratio is 10%, and if someone deposits $100, it will increase up to $1,000, and the $900 will be the main deposit, and $100 the new created money. That's how it works. There is another topic is money market. So what are those? Trading of short-term assets, maximum tenure, usually 365 days, wholesale transaction, high liquidity, low risk, low earning. And Cambridge quantitative theory of money is described here. Here, money is 1 by P into PY, where M is equal to money supply and KPY is equal to money demand. And if interest and money demand has interest and money demand has the inverse relationships. If interest increase, money demand decrease, and if interest decreases, money demand increases. As we can see here, KPY is equal to TD plus PD. So, what is money market equilibrium? Here we have seen money MS is equal to MD, which means money in stock is equal to money in demand. Here we have described again, M is equal to KPY minus IH. Here M is equal to money and KPY means stands for money demand, I for interest rate, and H for, that's what it means. So what are the functions of central bank? It supervises banks, control currency, formulate monetary policy, acts as banker to the government and commercial banks, serve as lender of last resort, which means all banks, other banks are bankrupted, they can get loan from the central bank. So here we have seen the function of central bank is demonstrated here in this picture. The next, the relationship between money and output. So what is the equilibrium between money market? Money supply and interest rates have an inverse relationship. A larger money supply lowers market interest rates, making it less expensive for consumers to borrow. Conversely, smaller money supplies tends to raise market interest rates, making it pricier for consumers to take out a loan. Here, there is a beautiful graph shown the relationship between money and its output. Here, from the x-axis, there is quantity of money, and in y-axis, there is interest rate, and the graph shows the relationship between money and output. If money increases, interest decreases. From this graph we can see, and if interest rate increases, money decreases. So from here we can see that from this graph, the relationship between interest and investment is inversely proportional. We can see if the interest is increasing, investment also decreasing. On the other hand, If investment is uh, increasing, interest rate is automatically decreasing. And here's another graph. For increasing money, aggregate demand will shift upward, and as a result, output Y will be increased. So, the relationship between money and output is proportional. So, thank you. This is my presentation for money and banking chapter. Thank you for watching this video with patience. Assalamu alaikum.